Hey guys, welcome back to my channel. And today we're going over some real estate book. So get y'all tea out, get y'all notes out, and it's time to get it cracking. I'm back with the study with me. If you don't know, my name is Jazzy the Realtor, and it took me 5 times to finally pass the test. I passed on the 5th. Disclaimer, I have water in my ear, so when I'm talking, all I can hear is like squeaky water gushing around in my head. So if I take a second and a pause, it's because this freaking water is like in my ear. But anyways, today we're going to talk about unit 13, which I think is chapter 3 for us. It's government involvement in real estate financing. So this chapter, I'm telling you off the bat, it's a lot. Like this thing here, I think is like 30-40 pages, but we're going to go through it. We're going to talk about the essential stuff and what you actually need to know, and how I can teach you guys how to apply this stuff to day to day and what's important versus what's not. This is the first chapter I learned when I got into real estate. So when I went to take my course, I was in a school that was, what is it called? Rolling enrollment, whatever you call it. And I came in and I was like, whoa, this is a lot. Like when I came in, he was like, hey guys, we're gonna get started. And then he's like, okay, everybody go to crack open chapter 13. And I'm like, chapter 13, where's chapter 1? And backstory, I grew up in real estate, so I know real estate. I knew how to sell a house before I even knew how to sell a house. You know what I mean? You don't probably know what I mean. But anyways, this chapter is a lot, and all we can do is just get through it. So let's just get started. I just want to say I hope you guys are having a great day, and I just want to push positive and good energy to you. And you can pass this test. It's just going to take some time and some energy and a little bit of tears, because everybody got to cry now and then again. But let me bless you today with this video. Okay, boom. So what are we going to learn in this chapter? Again, this chapter is called Government Involvement in Real Estate Financing. Most of this video I'm going to be looking down because I have to read, and I gotta do both. Okay, so in this chapter we're going to be learning about, number 1, government influences, primarily the Federal Reserve System; 2, the primary mortgage market; and 3, the secondary mortgage market. So clearly we're going to be talking about, let's just think. When you're talking about the market, the real estate market, and the loans, and how the government has something to do with the loans. So first, all of this comes from the Federal Reserve System. So the role of the Federal Reserve System, the Fed, the ops, acting through its board of governors, is to maintain sound credit conditions, help counteract inflationary and deflationary trends, and create a favorable economic climate. Boom. We got that? We got it. Next, primary mortgage market. So the primary mortgage market is made up of lenders that originate mortgage loans. These lenders make money available directly to borrowers. From a borrower's point of view, a loan is a means of financing an expenditure. From a lender's point of view, a loan is an investment. Okay, lenders can sell mortgage loans, which produce income to make more loans, and some lenders derive income from servicing loans for investors who purchase loans or servicing loans made by other mortgage lenders. So servicing loans include, number 1, collecting payments. So that could be taxes and insurance. 2, accounting. 3, bookkeeping. 4, preparing insurance and tax records. 4, oh snap, we said 1, 2, 3. Dang, I'm messing up already. 5, processing payments of taxes and insurance. And 4, following up on loan payments and delinquencies. So how do these loan people get paid? There's a few different ways. Clearly we just saw by servicing the loan or by just funding the loan. They're gonna get money. Major lenders of home mortgages and commercial property loans include, there's a few things that are included in this. They have savings associations, insurance companies, credit unions, pension funds, endowment funds, investment group financing, mortgage banking companies. And this is the thing, none of that I just said matters. That doesn't really matter for the test, but you should just know this stuff just to know it. That's why I'm skipping over it. So I'm going to also let you know if this is irrelevant or if it's relevant. Okay, the secondary mortgage market, which is where all the glitz and glam come in. So when people who don't have the traditional funding, they don't have the money just to buy things right out, or they can't put 50% down on the loan, they're gonna go through the secondary mortgage market, which is the secondary mortgage market in which loans are bought and sold only after they have been funded, quote unquote, closed. Okay, the secondary mortgage market thus helps lenders raise capital to make additional mortgage loans and is especially useful when money is in short supply. By freeing up capital for additional loans, the secondary market stimulates both the housing construction market and the mortgage market. There are a few types of institutions, that's what they're called. So number one, we have Fannie Mae, we have Freddie Mac, and we have Ginnie Mae. So we're going to talk about a few of them, but just to get to the nitty gritty, Fannie Mae is conventional, FHA, and VA. And VA mean veterans. Thank you for your service. Freddie Mac is mostly conventional, and then Ginnie Mae is special assistance loans. Okay, so I don't know if you guys want to really hear a lot of the backstory about each of these loans, because I don't think it's that deep, but it's that deep to the point where you need to know it just to know it, but you don't need it that deep to know it for the test. Got me. Okay, so Fannie Mae. Fannie Mae is your bestest friend, is cousin J from down the block, like not even no, is cousin F from down the block. So Fannie Mae was created as a government agency in 1938. You don't need to know that. It became a completely private shareholder-owned corporation in 1968, although it is still under congressional supervision. Fannie Mae buys from a lender a block or pool of mortgages that may then be used as collateral for mortgage-backed securities that are then sold on the global market. Fannie Mae deals, pay attention, Fannie Mae deals in conventional as well as FHA insured and VA loans, like I just told you. One of the most important features of the GES that has been their development of standardized loan application, credit report, appraisal, and other forms that are required for loans that they purchase, as well as detailing guidelines for the lending process. So basically they really like started all of this, making sure that people who don't have a whole bunch of money are able to buy. Cheers to y'all, but it's juice. Freddie Mac, hope y'all didn't see these. Okay, Freddie Mac, originally called Federal Home Loan Mortgage Corporation, Freddie Mac was created in 1970 as a privately owned corporation, but is now also known under the government conservatorship. Freddie Mac continues to provide a secondary market for mortgage loans, primarily conventional loans. And again, all of these, like I just told you, I told you what you need to know in the beginning. Now y'all just listening to what y'all listening to, because I'm just teaching y'all. But just know it for a grain of salt. Farmers Mac. Oh my goodness. Hey. Okay. Farmers Mac. The Federal Agricultural Mortgage Corporation is privately owned and publicly traded and was established by Congress in 1988 to create a secondary market for agricultural mortgage and rural utility loans, and a portion of agricultural and rural development loans guaranteed by the U.S. Government of Agriculture. I don't know nothing about that. I don't want to know about that. God bless the crops. But I am from the North Hemisphere, the North You know what I mean. I'm Connecticut, right by New York. Like we thugging it. Like I don't know nothing about no agriculture. We don't really do those loans up here, not really. So that's more like the South. So, and somebody actually commented about that. They got a lot of that down there, but that's not on the test. Next, Jenny Mae. Jenny Mae, the Government National Mortgage Association, Jenny Mae, was created in 1968 and has always been a governmental agency. Jenny Mae administers special assistance programs and guarantees investment securities issued by private offerers such as banks, mortgage companies, savings and loan associations, and backed by pools of FHA insured and VA insured mortgage loans. Next, okay, mortgage program. So you guys know how you be like, are you ready to buy a house? Do you need a do you got a loan, or do you got a loan? Do you got a pre-approval? Do you got a pre-approval? Is it FHA? Is it conventional? That's what we're going to talk about right now. There's really not a lot to talk about, but there's just a little bit to talk about. So let's talk about it. So loan programs. Mortgage loans can be classified based on the loan to value ratio. So debt of the loan versus the value of the property, right? Or the sales price, or whatever it's appraised out to be. That's very important because loan to value is going to determine how much your client's mortgage payments are going to be. What is that? Lord, why am I blanking? The interest rate is going to be. That also factors in not really with the loan, but the total mortgage payment, what the home insurance is going to be. So you have to make sure you're picking the right loan, and also what affects that is your credit. So let's get it cracking. Conventional loans. Conventional loans are viewed as the most secure loans because of the loan to value ratios are often the lowest. So that's usually when you hear somebody's putting 20% down. Usually with a 20% down payment in a conventional loan, there is no additional insurance or guarantee on the loan necessary to protect the lender's interest. A loan with less than 20% down usually will require private mortgage insurance. You need to know that. A conventional loan is not a government insured or guaranteed, unlike FHA insured and VA loans. Next, private mortgage insurance. One way a borrower can obtain a conventional mortgage is with a down payment that is less than 20% of purchase price by obtaining private mortgage insurance, which is called, you guys should already know this. What is it called? Say it. Write in the comments. No, you don't write in the comments. PMI, which means private mortgage insurance. The borrower purchases an insurance policy that provides the lender with funds in the event of the borrower defaulting on the loan. This allows the lender to assume more risk, so the loan to value ratio can be higher than the loan to value ratio can be higher for other conventional loans. PMI protects the top portion of the loan, usually 20 to 30%, against the borrower's default. This means that if the property is sold at a foreclosure sale, it is sale for less than the outstanding balance of the loan. The PMI is usually enough to make up the difference. The borrower pays a monthly premium or a fee while the PMI is enforced. Sometimes, not sometimes. We got a subscriber! It's live, baby, live! Okay, I gotta act like I'm not drinking, y'all. I really got some juice in my cup. Okay. What am I talking about? What am I talking about? Oh, so the PMI. So when you're at closing, you're going to be, well, you should be at closing, because if you're a good agent, you're going to come to closing, because why would you not come to closing? So you give your clients a gift when they first get there. This has nothing to do with what I'm talking about, because I was really just hype about my new subscribers, so y'all should subscribe. Anyways, so you're sitting down at the loan table, not the loan table, you're sitting down at the attorney table with the loan package, y'all closing, and then there's gonna be this page, and it's gonna be this long page, and it's called the immunized. I don't know, it's the whatever you wanna, I don't know the name, but immunized, something like that. list, and it shows you every payment that's going to be made in the date and the interest paid and all that. And then you'll see the payments go down after 30% of the loan is paid. That's because they're paying PMI, and it could be $100, it could be $200. I don't know. FHA insured loan. So if you haven't heard the word FHA yet, maybe y'all shouldn't be in real estate, because y'all should know the word FHA. Like, just not even from real estate, not even from your class, but just in regular life, you should be hearing about that. FHA, the Federal Housing Administration, which operates under HUD, neither builds homes nor lends money. The term FHA loan actually refers to a loan that is insured by the agency. An FHA insured loan must be made by FHA approved lending institutions. So it's usually a fixed rate, 10 to 30 years. And the lowest amount you can put down is 3.5%. But all that, we don't even need to talk about it. That's all I'm gonna talk about for that. This one I'm gonna tell y'all. You need to know this. When you are dealing with somebody who has FHA, there are certain things you need to make sure you're paying attention to when you're looking at property. For example, if they're trying to buy a condo, there are certain FHA approved complexes. So if they don't have their acts together and they're not in the system and they haven't applied to be approved by FHA, your client shouldn't be looking at conventional loan, regular houses, regular complexes. They need to be FHA approved. For example, if the siding on the house is messed up and there's like paint chipping on the house, that's out. Especially if it was before a certain year, I think 1967 or whatever, that's out. But I think in general, you can't have that. The seller's gonna have to paint it, and that's gonna cause some stuff. It has to be livable conditions with the FHA loan, because they're a first-time home buyer and they just want to make sure, you know, things is good. So there's certain criteria that you have to meet for FHA loan. So make sure that as you're learning and you're taking people out on properties, you need to ask the realtor these questions. So before you go to the property and it's looking a little sketchy, will this property pass FHA inspection guidelines? And they might say yes, they might say they don't know, but ask. Okay? Okay. And I could do a whole video on that. If you guys want to see that, pop that suggestion down below, because I can talk about that, because it could not destroy your chances of getting the property, but it can make things difficult. And I actually have a story time coming at some point when I get over it, because I'm annoyed about it, because I had a deal and it blew up because of some drama. Okay, but anyway, and it had to do with FHA. Okay, discount points. Discount points has to do with the loan, preparing of the loan, the broker, the points. So at closing, there's a certain amount of points you have to pay. It could be 2 points, 5 points. It all depends on the interest rate and how much you're putting down. They try to make it work. The broker will try to dupe you and try to push the points up to make you pay more. So make sure you got a good lender, because they will try to screw you. Discount points are not that deep, but it's the how do I say it? It's 1% of the purchase price. Oh no, sorry, it's 1% of the loan price, each point. Not the purchase price, but the actual loan itself. Assumption rules, FHA assumption. So what was, I'm like, what was that? Assumption rules. If you have an FHA loan, someone can assume your loan, meaning that they can take over your loan, but they have to qualify. HUD home sales. Foreclosures of FHA insured homes by HUD provide opportunity for both home buyers and investors. HUD accepts bids on foreclosed properties only from real estate professionals who are registered with HUD and does not deal with the general public directly. Properties are sold as is condition, in as is condition, which means that HUD will not make repairs prior to sale. Which is also annoying, because you have to go on this website and you have to do like this whole process, and it's just like too much instead of just putting an offer in, and you have to bid. But whatever. VA guaranteed loans. I don't want to spend a lot of time talking about this, because this is like a whole thing in itself. It's not really on the test. All you need to know about this I'm gonna read a little blurb and then I'm gonna read what you need to know. The U.S. Department of Veteran Affairs is authorized to guarantee loans used to purchase or construct homes for eligible veterans and their spouse, including unmarried spouses of veterans whose death were service related. VA also guarantees to purchase manufactured homes and the lots of which to place. So there's a whole bunch of stuff that you have to be qualified, like 90 days of active service. I'm not going through over all that, but what you need to know is that VA is going to issue a certificate of reasonable value, CRV. Get it in your head, because they're going to ask you a question and you're going to mess it up because you're not listening to what I'm saying. CRV. How am I going to remember this? Crab legs, ragoon, violin. I don't know if that's going to help you remember the test, but that's just what came to mind. Crab legs, ragoon, violin. Jazz play the violin. I don't know. Remember it. Certificate of reasonable value for the property being purchased. CRV states as the property's current market value based on VA approved appraisal. So basically, you just have to make sure if you get a VA loan that it needs to be based on the VA appraisal, the appraisal. Yeah, they have to appraise it out, VA itself. And if they don't, then you're not getting a loan, or you have to come out of pocket. Okay, we're almost there. Like, we're actually almost there. We got a few more pages. I'm not gonna go through all this stuff because I'm already getting tired. We get 23 minutes in this video. Like, okay, if you hanging on, press a like down below. Like, I think this is how you have to learn. Like, if it's not interactive, if it's not entertaining, like, boo, go to sleep, tomatoes, like, we have to wake up, we gotta get this done. Okay, next, other loan costs. So the seller is allowed to pay for some of the closing costs. This is for VA loans. But this is in general. This has nothing to do with just VA. This is in general. Okay, I don't know what happened, but the camera just went out. I don't know. Like, you know how sometimes it stopped recording? Yeah, it stopped recording. Okay, we're back. We're back in action. Like I was saying, other loan costs. So we're talking about seller's concession. Seller's concession is, let's say the buyer doesn't have enough money, the seller can come in and raise the purchase price, and then they don't have to put that money down. I'll make a video on that because it's already complicated. It's overcomplicating things, but if somebody doesn't have all the closing costs, you're able to work around it. Prepayment privileges. So you guys should know this by just having a regular car loan. Like, you might have a prepayment penalty fee, or you might have you don't have to pay the prepayment penalty. Meaning that if you decide to buy the house out in full and just pay the whole thing off that day, they won't charge you a fee. Assumption rule. This is something to do with VAs, but you no longer can assume a loan without the consent from a lender. Okay, I'm not gonna talk about the Farm Service Agency, which you guys should know. So there is a question on it. I'm not talking no more about the farms. Okay, other financing techniques. So there are different types of loans. There's like 6, and that's all I'm talking about, because after that, all this other stuff can be another video because it's not that deep. Okay, so we have, and this is stuff you need to know, what I'm about to share with you right now. Package loan. And I'm gonna say this so quick and so simple, you're gonna be like, whoa. Package loan, everything is included. A package. You buy the house, you buy the furniture, you buy everything included. Boom, package loan. Blanket loan. A blanket loan is this property and this property. It's a blanket. You buy, it's a loan for 1, 2, 3, 4, 5, 6 houses. Everything's inclusive. Open-ended loan. This one's a little tricky. An open-ended loan provides a security interest with a note is executed by the borrower to the lender, but it also secures any future advances of funds made by the lender to the borrower. The interest rate on the initial amount borrowed is fixed, but the interest on future advances may change depending on the market itself. Okay, basically open-ended loan means you can go back in and do what you got to do. Okay, next, construction loan. A construction loan is made to finance the construction of improvements on real estate such as homes, apartments, and office buildings. Construction loans are generally short-term or interim financing. So good on that. We're good on that. Sell and lease back. What does that mean? You sell it and then you lease it back. Literally, you have a property, you realize, okay, I can't pay the mortgage, or I am tired of paying the mortgage on this property, or I need a large sum of money. I can no longer do this. So I'm gonna find somebody who wants to buy my property, but I'm gonna then lease the property out. I'm gonna rent it out from them. Buy down. This one is also a little rough. And after buy down, we have the HELOC, the home equity loan, and we're done. Okay, buy down. A buy down is a way to temporarily or permanently lower the interest rate on a mortgage or deed of trust loan. Perhaps a home builder wishes to stimulate sales by offering a lower than market rate, or first-time residential buyer may have trouble qualifying for a loan at the prevailing rates. The buyer's relatives or the sellers might want to help the buyer qualify. In any case, a lump sum is paid in cash to the lender at closing. The payment offsets and so reduce the interest rate in monthly payments during the mortgage's first few years. Typical buy down arrangements reduce the interest rates by 1 to 2% over the first 2 years of the loan. After that, the rate rises. The hope is that the borrower's income will also increase, making it more likely that the borrower will be able to pay the increased monthly payment. Home equity loan. Home equity loan is a source of funds that takes advantage of the equity buildup in a home. So let's call it a HELOC. So let's say you have like you've been paying mortgage down, and you have now $100,000 in equity. You could not literally take the equity out of the house, but you do this thing called HELOC. You basically take an equity loan out of the house. And then you could take that money and then you have to pay it back in small payments over whatever duration. Excuse me, y'all, we did it. That's the most important part of this. What we do need to go over, the next one, is equal credit opportunity, Community Reinvestment Act, and then like the Z regulation, all that little stuff. But that don't take no time because it's not that deep. But I hope you guys enjoyed. I hope you guys learned something. And please comment any ideas that you guys, things that you want to learn. If this was helpful, please let me know. If it was productive, let me know. Just let me know how it could be better. And pass this test. I want you guys to have a great rest of your night. And it's Liddy, Jazzy the Realtor. She out. Peace.